So everybody talks about option selling, and option selling is very expensive. So we thought we will bring a strategy to you which is costing less, at the same time you are going to make good return also. Now I'm going to show you a live example which we shared with our members who have downloaded our app. So in case if you want to download our app, please check the description below. We have a link where you can download the app and you can have access to these kind of strategies also. Now this strategy, the cost of deploying this strategy was around 2.25 lakhs. And we made a profit of around 7% return on investment. So that was a very highly volatile month, and we did this strategy. We deployed this strategy between 17th of March till 14th of March. So if you see that period, it was highly volatile period. So market were gapping up, gapping down. Yeah, this is the period. So we deployed on 17th of March and we exited around 24th of March. See here, one day market was gapping up, then it came down, then gapped up, it went up, then gapped up, it came down. So it was highly volatile month. So how do we manage these kind of two-way, three-way move? That was the objective of our strategy. We had to deploy a strategy and it has to make us money in case the market moved up and down violently. And this was a very live trade. Whoever members who took this trade had made a good profit. Now let me go to our app, right? So this is the back end of our app. So if you see here, what we did is on 17th of March, on 17th of March, we deployed this strategy. So what is the strategy? Details of the strategy I will explain, or even I will construct how to deploy this strategy also. We will explain. So what is the strategy? The strategy is nothing but, so this was the strategy. So the break-even point was between 16,800 to around 17,800. So there was a wide range of 1,000 points. Why we deployed this strategy? As you know, markets were highly volatile in the month of March, right? Nobody was able to make, I don't know about others, I was not able to make money because of high gap ups, gap downs, and I usually say that these things. The worst enemy for any option seller is going to be any big gap ups or gap down, and that is what happened in the month of March. So we were not able to make a good, like it was, we didn't make any loss. It was running cost to cost. So we were very curious. We want to make some strategies which were foolproof, or which was protecting this, or which was not damaging because of any gap ups and gap downs. So what we thought, we try to deploy some very simple strategy, or let us say we did a kind of ratio spread strategy. So if you see here what the strategy was, this is the strategy itself. So this was a very live trade. So market was around, let me go to this one, okay. Market was around 17,300, around 17,350 levels. So we bought 17,350 call option and put option one lot, okay. Market is at 17,300. We bought 17,350 call option and 17,350 put option, one lot each, okay. Then what we went on the downside and we sold 17,000 put option 5 lots, and on the upside 17,700 call option 5 lots. So the total is are like 1:5 ratio. So this is not correctly a ratio spread, it is a kind of ratio spread. Because why am I saying is this is because if you consider ratio spread, you will have to do 1:2 ratio, or 1:10 ratio, or 1:15 ratio. So it depends. So ratio spread is a very advanced subject or advanced strategy. I don't want to talk about ratio spread now. But for this, what we did is 1:5 ratio. Then after selling 17,000 put option and 17,700 call option, we went further out of the money to 16,600 put option and bought 5 lots, and 18,000 call option, we went further up and bought 5 lots of 18,000 call option. So this 18,000 and 16,600 put option was a hedge, pure hedge. and this 17,000 call and 17,700 call and 17,000 put was strangled. So this is where we make money. The idea behind deploying 17,700 call and 17,000 put was to make money. Then what we did, we bought 17,300 call and put. So we went long straddle in one lot only. So 1:5 ratio. So what happened here is, on if you see here, on 17th of March was a Thursday, 18th was a public holiday and it was a holy. Yeah, 18th was a holy. So next day market was opening at Monday, which was 21st of March. So market gapped up on 17th of March. Market closed at around 17,287. Next day, that is Monday, 21st of March, market gapped up around 17,329, around 60-70 points gap up. Still, it will be in profit only, and because market gapped up around some levels, around 17,300 levels, and our break even was around 17,700 levels. What happened is, our strategy was still in profit only, but we don't want to make any adjustment. So let me take you here. Yeah, this is how the market was. This is how the strategy was looking. So let me close the previous one. Yeah. So this one. This is the status of the strategy on 21st of March. So 17th we took the strategy, 21st of March, this was the status. In spite of market gapping up, then market coming down more than 300 or 400 points, this strategy was in a profit. What happened then? On the same day, market kept on falling. So we had to do some adjustment. So what is the adjustment? Now, everyone knows this strategy. This is a very simple ratio spread, and we have to make 1:5:5 ratio. That is, one is the buy and 5 is the sell and 5 is the hedge. So this is a very simple strategy. Now what we have to do is, or what you want to know is, that how to manage these kind of strategies, how we are going to manage. That is the thing here. Now on 21st of March, market came down around, it came down, if you see this chart, market came down around, close was, it gapped up around 17, opened at 17,350 levels, then came to 17,100. So around 250 points it was coming down. So in order to manage that position, what we did here is, I will show you. In order to manage that position, we did some adjustment. The adjustment was, earlier we had 17,700 and 17,000. If you see this one, 17,700 call option and 17,700 call option, yeah, and 17,000 put option. Now 17,000, since the market was coming down, that 17,000 put option, which is the original strangle in our original trade, was there. It was in a loss. We didn't do anything on that. Since the market came down by around 250 points, market dropped down by 250 points, we booked a profit of around 10K in 17,700 call option. Right? And what I did, once I booked profit in this one, I sold another 17,500 call option. Right? So original put side, I have not touched anything. Only I have touched is, since the market was coming down, I squared off 17,700 call option and I wrote another 17,500 call option. So once that was done, the chart was something like this. Now it will show loss only, because the 17,000 you have booked profit in 17,700 and you have rewritten 17,500 call option plus the 17,000 which is actually there, will be there only, because it will be in loss and your graph is going to be showing loss only. But what the thing here is, you have to understand is that, since you have done this strategy, your mindset will be that, okay, I have already booked profit, and this is not the actual profit. The actual profit is just 1,500 rupees. You have already booked profit in 17,700 call option around 10,000 rupees. Once you rewrite 17,500 call option, your losses is 11,000 rupees. Okay, but your actual loss is just 1,500. Okay, that you have to remember. I hope you understand this concept. Now, what happened once I did that trade? Once I did that trade on second day, that is on 23rd of March. Look at the strategy. Market again went up on the upside. See, on 23rd of March, on 23rd of March, 22nd of March, market closed at, Nifty closed at 17,300, and next day it is gapping at but 400. You see what the strategy has done. Once that was done, this is the live trade as of 24th of March. Yeah, is it 24th of March? Yeah, 23rd of March, one day before expiry. This trade has come to a profit of around 4,829. So you have already booked a profit of 10,000. Plus you are having a profit of 4,000 here. So total profit now as of 23rd is around 4,000 rupees. Let us say 5,000 rupees. Okay. So 15,000 you are sitting in a profit. Now we were waiting for this trade to see what is going to happen. Next day, what happened is that on expiry day, just before one day before expiry, again market came down. So if you see here, on 25th, this is the 25th of March. Yeah, this is the expiry day. Market came down. Market came down by around 70 or 80 points. So on expiry day, this strategy was in a profit of around 18,000, and the same day morning we booked a profit of around 18,000 in this strategy. So the total capital required was around 2.5 lakhs. And profit booked was around 18,000, say 19,000. So 7% return on investment in just 1 week. So so in 1 week the profit was around 7%. So that is an excellent return, right? So this is how we manage two-way or three-way move, right? I hope you understand the strategy, and I can construct this strategy, but it is going to take more time, and already this video is more than 12 or 13 minutes. It is very simple. You go long one lot, you go long in. You do a long straddle, and you sell a short strangle, and you hedge that short strangle. I did 1:5:5 ratio. You can do 1:3:3 ratio also, or even 1:7:7 ratio also. It completely depends upon your risk appetite. So this was a very simple strategy. We do share strategies, very advanced strategies like this in our application, Option Sense application, which you can download from our Google Play Store. I hope you enjoyed this video, and I think this video was informative to you. Thank you for watching. Take care. Bye.